shadows creep while you and me repeat. This bittersweet heat is suffocating. I'm waiting and always hesitating. Kryptonite desires set my heart afire. Heart on fire. Set my heart afire. With crimson.
I think we're good to go. I think we have sound now. The cable was plugged out of the back of the microphone. I have no idea why, but yeah, sure. Let's see now. Hopefully we have a bit of life here. Yeah. Right. Okay. We have sound. I think we're all good to go. So I hope everyone's been well. Big history was made this week. As we can see on screen here, Bitcoin made new highs. So yesterday morning, you might have seen on my Instagram. We made this level here, which was kind of you don't know exactly what level it's gonna make, but we could you can formulate a fairly good idea off of where price will go based off of a high. So we made this high yesterday morning, early afternoon. So never seen before. Previous high was here at about 58.1 in that region. But I always mark my ATH on a chart just with a yellow line, big kind of blocky golden line. Say something like that is what I'd usually put for an ATH. Just clogs up the chart. Sometimes I delete them off it, or if I go and replace remove drawings and remove indicators, you can clean up your charts that way. But typically the likes of Bitcoin, where it's actually making history, that a cryptocurrency, it's phenomenal that a cryptocurrency is worth that kind of ridiculous amount. So we'll just make sure that we still have people. Right, we have one person, so look, the show must go on regardless if there's people here or not. It's still going to be content for the channel, so people can catch up. Don't necessarily have to be here live, but it's going to be posted anyway. So whoever's there, I hope you're enjoying yourself so far. As look, we're only in a couple of minutes anyway, so it's running 8 minutes. I actually forgot to hit the start stream button, so I was just here bopping to music myself, and it wasn't even being shared. So I know I did it there just for the last 2 minutes of it, but yeah, it was the waiting room thing was open for a couple of minutes. But yeah, anyway, so we get into this thing with Bitcoin, right? So we're looking at the 15-minute chart. Just shows a little bit more, since the new high is only yesterday evening. We don't have much information to go off of. Like if we're looking at this on the hourly chart, it just looks like a big downward trend. We can see that there's an overall downward trend forming, but that's only regression from a big massive drive. I wouldn't take that as any indication that this is going the opposite direction. I'd say if this, like, we could see maybe price see down this location down here, we could start to see a little bit of consolidation starting to form. We could see consolidation in this zone here. We'll change it over to consolidation color. So we might, the fact that prices after coming down into this region now, it's after creating a low, this low, it's the same as that kind of low, but we're not after breaking this level yet. So the level that was created by the first retracement up to the second new high, so the new high is $61,781.83. So yeah, price got up to there, and it's slowly been coming back down. We can see by this should be a red line, because it's a downward one. So you mark your downward trends. If you've seen the video, you mark your downward trends from the highs, because you're going to be shorting from the high points. You're going to be selling in a downtrend, shorting in a downtrend. In an uptrend, you mark off the lows, so you're going to be buying or going long from the lows, from each bounce. You're going to be bouncing in the uptrend. You're going to be hitting your head off the ceiling coming down. So that's the downtrend line. So yeah, there's resistance, obvious resistance here, came up, created a high, came up, revisited it, but pulled back down, came up, tried to get it again. So there was a small regression trend starting here. So a regression just means it's going to be pulling back, and then slowly creating lower highs over time. This is fairly insignificant, because if you look at this on a 1 hour chart, you can just see it's a general downtrend. There's a lot of bearish pressure, like bearish hammers, pin bars here. Look, there's a lot of, see what this candle tells us here now is that there was a lot of sellers, but there was a lot of buyers. That the sellers pulled the price back down, but the bulls came in, they reacted, and they said no, this isn't going low, this is rallying. So the fact we are after seeing this little level down here, in here, isn't it, for my ellipse, we have this key point here now. So we're revisiting support, and when we revisit support, so if it reacts if it uses the support as support and continues to the upside, it's after confirming that is we've confirmed that is a level that price will react at, because we can see these levels, these candles wicking down into this zone. We can see them wicking down into this zone again. So it has confirmed that this is a valid level of support. Up here, same thing. We had our visit of resistance, revisited the resistance, came back again, tried to get there, didn't quite get there, but it's still coming up to that area, and that's the important thing. It is revisiting, and it's actually retesting. So you might have heard me on about something retesting before, and what that basically means is it's just coming back up to a previous level that it's visited before. So we can see that there's so we have the high. So the highs are always a considerable level of structure. Lows, overall, like, this would have been a considerable level of structure from the previous all-time high, right? So when people, like, see price was getting close to that line, so people get, it's resistance. Price will react at resistance, but it's more likely to react at resistance. So when it comes up, it's likely to come down off a resistance. So people were shorting here, and there wasn't enough buyers to bring it to the line to bring it back down again. So some people might have had limits set in this location. So people might have had limit orders put in here, but price didn't quite get there, so they actually missed their position. So that's another thing you need to watch out for when it comes to the likes of a trading plan. You have to have how close to the resistance, because when it comes to it, you're not always going to hit the resistance. Sometimes you're going to blow through, you're going to hit the resistance and pop off it, like, almost perfectly. I'd say we could cherry pick an example just off of this recent. Say, like, someone might have had a limit order here. They might have had it set right down at the end of this, they might have set it off of that level. Someone might be going for a short position. They might be expecting a short position, and they might have a short order set here, wicks just above, or stop loss just above, aiming for previous support, and that's a trade setup that someone might actually take when price gets up there. But you don't just take that trade, obviously, and I'm a big advocate for having multiple entry reasons. So, like, you're not just going to enter this just because it hits a level of support. You're going to have, like, some people might like if you watch the video there this week, this RSI indicator, I mentioned this. So a part of a trading strategy might be so we have this zone. I think by default, this is the default one. I didn't mean to put on the default one. I have my own custom one set up for one of my strategies. See here, so I have the 25.75 and I have the 30.70, but I have the 50 line marked in the middle of it. I like to have the 50 so I know when price is fairly in the general kind of zone. RSI, longer the time frame, the more of a confirmation it is. So on 15-minute, hour time frames, like the whole concept of it, I'll bring out a video on the RSI indicator, but in theory, when price breaks out of this area, right, so when it breaks out of this area from 70 to 30, basically what it means is it's overbought up here and it's oversold down here. So if it's up in this zone, when it re-enters, that's your time to short and get in. And when it's down, see if we can get a point in time, say here, right, we'll go back. The hour, it's not the most the best one. See, like it only popped out for a second and then popped back in again. Like you have to, when it comes to using an RSI, and the reason I don't like indicators is because it's telling you based off of a formula. It's a robotic method for trading, and the problem with that is it'll tell you when to go in and when to go out, but it's going to tell you every single possible time without any shadow of a doubt. It's going to tell you when it's overbought and oversold based off of the figures, but it doesn't necessarily mean that is the time you enter. So like this one here, if this actually came back down there, you will have people that would have entered short positions here, and a short position here would have blown them straight out of a trade, but it didn't. It came to here, so in this position people would have shorted. So on the say at 4 a.m. this morning, so this RSI indicator, so price reacted off of support, or off of resistance, excuse me, and people might have had looked at this at 4 o'clock this morning. People might have been up early Sunday morning waiting for, the fact that there was the all-time highs and everything. That would be a fairly general, it wouldn't be expected. It would be expected that people would be looking at things after highs are made, looking for short positions off of pullbacks. Pullbacks, retracements, retract, loads of different terms that mean the same thing. So this basically said, right, when price broke back down here, so at this point in time, if you look over here, just at this number here, so we can see at 3 a.m. it was 72.88, so it was still above. But then at 4 a.m. it went 69.51. So this could have been an entry for someone. So at the start of the 4 o'clock candle, right, there would have been a signal for entry there. Logical stop loss would have been, sure, like at the level, it's unlikely to break the level straight away after. So the stop loss like that mightn't have been a bad one, and maybe entering a position like that. So you would have been in profit there. But numerous times I've entered trades without having a proper strategy, using an RSI, using ATR. Like I think there was one particular other content creator put out a strategy based off of Bollinger Bands and RSI only, nothing else, just purely RSI goes over a certain level, Bollinger Band is on the standard deviation line, enter. But the amount of times that happens and is completely insignificant. You can have RSI above 70, and you'll be on the upper band of a Bollinger Band, and the thing just rallies, and it just rides along that, rides along the Bollinger Band until it drops off, and you're just out of, like, if you didn't have a stop loss, you're completely after doing yourself over for God knows how many pips, because when something goes into a rally, it rallies, and that's as simple as it is. Like when it comes to, if you're talking about like maybe more short positions, price will always fall faster than it will go up. Like if you, like gravity will always bring things down quick, rather than if you throw a wall up, it's going to come, not necessarily with that example, but it's much easier for something to fall than it is to build. It's like a house, it takes so long to build it up, but all it takes is one weak wall and the whole thing can collapse down, if you get me. So you can see here, you do have these big rallies, but overall, if you look at an uptrend or a downtrend, like you can see here, price in this area, right, to get from say this level, right? So when price got up to here, right, it took from the 8th of February the whole way to the 17th of February, right, to get from this level, say from here, so like the 8th of February, the whole way to the 23rd, 22nd of February, 21st of February, in that kind of, say the 20th, call it the 20th. Go from the 10th until the 20th. It took 10 days to get from there to there, but it only took, well, say call it the 20th to the 23rd. It only took 3 days to fall off. That's the way price action works. When there's a pullback, it's going to happen faster than it is going to climb. And that's just the way the market works. It's harder to get something to go up because you need buying pressure to actually drive something up. And if there isn't a reason for someone to enter, you're not going to have a buyer, if you get me. So like, people aren't willing to invest if there's no opportunity to. Well, there's a lot of people that do invest regardless if there's an opportunity or not. And unfortunately, I have been victim to that form of a strategy in the beginning as well. If you were there for the video there this week as well, the one about the forex jargon that I'd be going on about, that video, I mentioned that I've never blown my trading account. Never, to this day, I've never blown it. I've blown demo accounts left, right and centre because I've tried strategies that have been completely ridiculous, like that one that I got off of that video years ago. And the whole point with it is, like, that particular strategy, the reason it doesn't work is because it gives you a decent method for setting a stop loss. Decent, not great. Basically, the whole concept behind the stop loss creation is you have your RSI and you have your ATR indicator, or your average true range, which is a volatility indicator. So it's basically telling me at this current hour there's a $616 volatility. So the price is expected to range that much by $616 this hour. This candle that's the volatility. If you look at it, it's more kind of, I use it more with a kind of a forex type example, and the likes of this strategy wouldn't be advised for a crypto strategy. Crypto is a lot more fundamental, in my opinion. Cryptos are much more fundamental in nature than a lot of other type strategies would be. So like forex, these kind of strategies do work kind of well. So like, if we take this example here, you entered on this you don't enter. When it breaks the top level of an RSI, you wait for it to come back. You don't enter. You don't enter when it goes in, because that means it is over. So it is overbought, but it could go higher, and obviously it did. It got the whole way up to nearly 90 on the RSI scale. So like, that's extremely high. That's extremely over. If it gets up to that point, you'd be nearly better off to get in at a, but you always need your confirmation. There's no point in doing things without a confirmation of a trade, and an entry on an RSI is not an entry for a position. Like, if we entered back in here, right here, where price is still at 75, so 65 right here at this one, right at this candle, if you entered here, you would be straight away in a loss, unless your take profit set right here at this wick. You're not making profit. You're blown straight out of your stop loss, 100%. So the RSI doesn't work the whole time, and that's the reason I don't like it as an indicator. I don't really like the RSI. It tells you whether this particular pair or stock or crypto or whatever you're looking at, if it's based off of figures, is it overbought or oversold? Right, oversold meaning that's below 30, by the way. And then I have another one of the RSI, or of the RSI, set up with the 2575, which is basically a bit, see, like, when it breaks out, it tells me more. It's more of a significant level of overbought or oversoldness, if that's a way of talking. So like, look, there's loads and loads of positions. Say like the US yen in 2020 and the most of 2021 as well. Well, more so start from 2021, the start of 2021 has been very, very bullish, right? And what that would mean is, and it's in the RSI, it is visible that there's a lot more oversold signals on the RSI than there was. There's more oversold signals on the RSI than there is on the overbought rather than the oversold. You get what I'm saying? So when it's oversold, it's more of a significant figure, and when you're in an uptrend like US dollar yen, you're not going to, like, you're in an uptrend. Right, we'll analyze the chart just really quickly. There's been price action over the last 2 months, 3 months, right? We can see that there is an uptrend forming in this area here. What some people like to do with this kind of a pattern is, they like to do an arc. So, wrong way. I don't particularly use the arc too much, but what people do is they plot their highs and then bring this in to kind of the general area of the price action, so maybe off that level, so you can see that there is an uptrend starting to form, and it's some people's ways of looking at a chart and getting their idea of the trend. So people can use arcs to signify trend, like this one, when it's a kind of a concave trend, when the trend is picking up and it's bellying a little bit, if you get me. Like, it can be done. There's a what's it called? The cup and handle. I think it's cup pattern. Cup and handle pattern. See it here. It's when price kind of dips and makes a kind of a belly and retraces, and that's the kind of signifier that it's going to be. It's a kind of a regression consolidation. It's a pattern, obviously, that you can identify from price action, but it forms from price coming up, and it regresses, it pulls back, but makes a little, it kind of consolidates, but doesn't show, it doesn't actually downtrend. It pulls back, but kind of consolidates in a kind of an upward manner. It doesn't necessarily have to make a semicircle by any stretch of the imagination. It just, when you look at it, you can understand that the price is it's more of a gradual return to a new level, and then it fakes out and blows up to the upside. So this handle could retrace back down to the bottom of the cup. It might only retrace a small bit, but it's just, this one actually might show it a little bit better. But this can show, so this actually shows a great example of what can happen on occasion with, these are only patterns. These don't give us, these tell us the general market conditions rather than an entry or an exit or a stop loss or a take profit level. So what people would have seen here is that kind of price retracing, making a kind of a belly, and then see the handle, like we saw in the last example, the handle pulling out. So what we see in this example is price coming up, making the cup shape, going down into the handle, and then going up. What we see in this example is price coming down to make the cup. Then it makes the handle, and then it does its move. Do you get me? And a lot of things when it comes to these patterns is they obviously don't always work. It's only a human interpreting price action and putting a name on it. That's really all it is. So what you say? Wait, how do you know you were in loss again? Okay, that makes sense. I don't know what you meant. You're in loss again. But you said it makes sense now. So I'll take it that you understand kind of what I'm on about. So I'm not going to try and find an example because this is a more rare price action pattern, but it's less significant than, say, a doji. Dojis are the dojis, and in case any of you don't know what a doji, candlestick pattern. Hold on, I'll put my phone on silence just really quickly. Put it on mute. Right, so we have dojis here, right? So, you see, I don't particularly like the idea of giving a candlestick pattern a name, right? For the simple reason that if I go off and I can look up all candlestick patterns, right? I can go off and I can learn off this whole list based off of their names, right? Like I could go, what's a tower top? Okay, price comes up. We see, like it's not weakening upwards. It's kind of it's getting to a point and it's just holding that level. We see a little bit of bearish pressure, but not enough to give us an engulfing signal and whatever. I'm learning it off of what I just said, rather than that's a tower top. That's a three black crows pattern. I understand price action. I don't learn off a candlestick reversal patterns chart or table like that, and then I say, oh, that's a three black crows or a bullish meeting line. I read the candles. I understand what these are the main kind of ones, right? Not even all the main ones, but the first couple that you'd actually look at. So bullish engulfing, bearish engulfing. Those are the kings of any price action strategy or any price action reading charts, all that kind of stuff. You have your doji, which shows indecision. You have pin bars. If I can get an example of a pin bar, is there a pin bar? So yeah, inverted hammer, shooting star, morning star, evening star. Just as some of them that I would know from morning star, evening star, morning star, evening star, and I'll get doji. They're all fairly similar in formation. Why wouldn't that start? Right, so this actually shows a very, these are separate charts now, right? So morning star would be coming down, a bearish trend coming to a bearish engulfing variation at the end, followed by a green candle. If it when it comes, I don't understand. I don't like explaining price action reversal patterns like this, because they don't, by words, they don't really mean anything, because it won't always be three candles in a row. It'll be a bearish retracement followed by bullish pressure, but you need to be able to interpret the candles to tell yourself that there's bullish pressure. So where's there so I don't actually think I brought out anything to do with candlesticks yet, and one good thing would be to show OHLC of a candlestick. Right, so when we have a green candle, I don't think I've ever gone over this before, and this is very, very important. With a green candle, you have an open, a high, a low, and a close. So you have an open, you have a high, you have a low, and a close. OHLC. If you look at a price action chart, you'll see them up here. OHLC, right? And then there's the change. Open is the open price of the candle. So it opens here. It comes down. It comes all the way up. And it pulls back a small bit and closes, right? So it opens, makes a low, goes up, makes a high, and comes back down and makes a close, right? In a bearish candle, it opens high, it opens at the top, it makes a high, comes down and makes a low, and pulls back up and closes, right? Those are the two types of candlesticks. On any candlestick chart, you will never see anything else other than a green or a red candle with an open, a high, a low, and a close. When you see a doji, it opens and closes relatively in the same kind of location. So if we open, no, we don't really need the whiteboard. I don't even have the thing set up, so we won't bother with that now for today. But a doji, for anyone that hasn't seen one before, would look something relatively like this, right? So we'll just draw a green doji candle. So green doji candle would look something like that, right? With this being much skinnier, which I showed it on the screen, right? But where we have price that's very, very, the open and the low, open and the high, the open and the close of the candle are very, very tight, right? Which shows that there's a lot of indecision. Indecision meaning that the buyers and the sellers are kind of at war with each other. No one's going up, no one's going down. So this could be considered a doji. See this one right here in this little circle? I'll just draw a circle around it. So you can see it just really easy. It doesn't necessarily have to be completely flat. It doesn't have to be completely flat at all. I'll just zoom in on it so we can get it nicely. I'll turn off these indicators. This is one of the main reasons when I'm doing candlestick analysis, I don't have indicators on at all, because it just mucks up your charts. So this is a doji, right? What we see here in this golden circle right here is a doji, because of the open and the low, open and the close being so close to each other. And you can have bearish dojis, but it's technically not bullish or bearish. It's the kind of thing you have to understand with a candlestick. With a doji candlestick, it's not bearish nor bullish. So I'm having real hard trouble Englishing today. So that's a doji. Another doji example. There's a bearish doji. I said it again. It's not bearish. It's not bearish nor bullish. It'll show as a color because it has to. It's going to show either one or the other. But it's the way you interpret it. There's another doji candle, right? The open and the close. They're very, very close. You're never going to get them slap bang on the dot. They're always going to appear like that one. Where was it? That one, is it? That one's all. Yeah, that one looks like it's a. It looks like a doji. The one beside it looks like a doji. There's no, and it's all me telling you it's a doji. You have to be able to understand that the price action around it as well is going to influence your formulation that it is a doji candle as well. I'm going to bring out a proper video explaining all this stuff kind of more in depth. But like, okay, this one here now, right? This is a typical bearish pin bar, right? So pin bar just literally means you have your bar, your candle body with a massive wick, right? This wick, we'll actually measure it. How big is the wick? So we'll go from, turn on that. Why is it not snapping? Right, we'll just measure it by eye. So we have a 300 pip wick. No, sorry. Yeah, 300 pip wick. That is ridiculous. Alright, we go back and we have another look. We'll hop over to a different chart. We'll find another one. We are looking on the daily chart now. This is there'll be a good bit of information now. Like, this is a general kind of an overlook of a chart. Like if you look at this, that's a week in price action on a daily chart. That's a week. Those 5 candles there. Monday, Tuesday, Wednesday, Thursday and Friday. That's a week in Forex on that chart. If you break it down to the 4 hour, there's your week. You get me? There's not a huge amount, and that's more for long positions. You use the longer time frames. Like as a scalp trader, you're sitting on 15 minutes all day, every day. Half an hour to an hour. Those are your time frames as a scalper. I don't scalp. Scalp takes up way too much time. It's profitable, no doubt. It is a profitable method for trading. People can scalp all day, every day and make serious profits. But you can't do anything else. And it requires you very, very often taking out your phone, you're constantly on your phone, checking your trades. You're constantly in front of your computer, checking your trades. Now, if you have any form of a life, scalp trading is not the way to go. Day trading, I personally, when I open a position, if I open a position at 6, half 6, 7 a.m, if I open one at 3 o'clock in the morning, if I open one at 7 p.m, if I open one whenever, right? I check my charts, say 11 o'clock, 1 o'clock, 3 o'clock, 5 o'clock, 7 o'clock, if I have positions still open, if there's news coming out about vaccines, anything to do with, say like with the Bitcoin highs, I was checking my phone a lot more than I usually would. I have Bitcoin in my portfolio, so I have a lot of, I'd be checking Bitcoin now a good bit. Like I even have a thing open. If you have a Samsung phone or HTC or whatever, if you have an Android OS, you can actually get the investing.com, and you can have a widget on your home screen where I have all my kind of the ones I'd be looking at the whole time with Forex, and a lot of my long-term investment positions, portfolio positions, Bitcoin, Tesla, the likes of all that kind of stuff, are all on my investing thing. So all I literally have to do, if I open my phone, all I have to do is swipe over twice, and I have my investing.com up there. it's just a widget. You can add whatever you want onto your widget. It's a quick little refresh button on it. So if you look at a price and you're like, that's the price it was 2 hours ago, you can just press that and it'll tell you the price at the current point in time. And it is good for monitoring day trade positions. So you're not actually going into Trading View and then checking, into your watch list. Like whenever I open a position on anything, I always lob it up into a green. I always flag it green on Trading View when I open a position, and Trading View for me opens faster on my phone, so I always use Trading View just to go in and monitor my positions. I have the AvaTrade Go app as well, which is very, very good. I have it set up that it needs my fingerprint or whatever when I go into it, and if I need to close the position or whatever, I can just put in the fingerprint and go in and close it. But I use, for monitoring the positions, I use Trading View, the Trading View app on my phone, which I just find is much, much better, because you can just, like, if I say I entered a position, just for a quick example, I'm not even going to look for an entry reason or whatever, I entered here, and I can open Trading View on my phone. All I do is click this button here, click that thing, it syncs up with the cloud. I open my phone, I'm able to go in and check where price is relative. So if we do the replay function, go to here, so I'm going along and I go, not quite there yet, not quite there yet, not quite there yet. Okay, entered. I entered here. So now I can take out my phone a couple of, say 3 hours later. Say I opened the trade at, pretend that's 11 o'clock in the morning, right? Boom, there's 12, there's 1. I check the trade. I can see on my phone that I'm still in the green. Simple thing. I can just quickly look at the price action. Yeah, things are looking bullish for the next couple of hours. Leave price run. This would have been an overnight kind of a position, not ideal. I would have, say, when I woke up, say there's 7 o'clock when I woke up, still seeing bullish pressure. We're still seeing relative higher highs and lower lows, or higher, these are higher highs and higher lows being created. So we're still seeing a good bit of bullish price structure. So it's a good thing. In that position, it wouldn't have been a great position to take, unless you took it back here on this bullish engulfing variation here. Stops, sure, like you could, long-term position, you could target up there, have a nice 3R close, 2.9 hour trade on that. At the moment, obviously the markets are closed. Actually, that's not completed price, but say that was a position we took, say, right? I didn't do any analysis to open that trade, by the way, and see, we're still in the green, right? So we might have had a position here just as a dummy kind of a trade, right? We entered, say this was our target, right? This previous kind of, maybe this one, right? This one here might have been a more attainable, or maybe halfway between, right? And you're going to have your stops maybe below this level, or maybe you go for the more recent one, because you can see this kind of, you might be looking at, that might be enough for you. You might be a real risky trader and you say, yeah, that price is after making a new high, a new lower high, a new higher low, so I'm happy enough to put my stops just below that. So I'm going to put my stop just below that and create myself a 7 hour trade. It's a very, very good risk to reward, but you're not giving yourself enough on the stop. That could bounce to here, rocket back down, retest this level, and throw itself up to the upside where you predicted it was going, but you're not getting it because you were too stingy with your stop loss. So you have to find a balance between aggression and passive trading. So like entering a position and putting your stop loss just before the more recent level. For a scalper, when you're instantly going to make the money back, if you stop out of a trade, you have a really, really tight stop loss, you might get stopped out. But on your next trade, you might pull a 4R at full lot size for your account, a full 2% risk lot size. You're pulling a couple of those in the day. It requires a lot of analysis and a lot of analysis and a lot of losses as well, because you are going to, like, when you're scalping, you are going to be losing consistently. because the volume of trades you're going to be taking and the amount of risk you're putting into your strategy, you're going to be losing high volumes. No, you're going to be losing frequently, but you're going to be profiting. When you profit, you're going to be profiting, and that will outweigh, all your kind of losses. So like a scalper could take 10, just say they take 10 trades in a day, and maybe 20 trades, but take 10 for an example. A scalper, like a scalper would take, just to take 10 trades as an example. A scalper might take 10 trades, he might lose 7 of them, win 3 of them. But 3 of them he won with a 5R, or he won with a 4R, or maybe he lost 6 and won 4, and he won with a 3R on the trades he won, but he lost with a 1R, or he lost his 1 on all his lost positions. So he's actually going to be green in the end of it, because you have 6 1s but you have 3 4s, which is 12, right? So you're gonna lose 6, but you're gonna make 12, so you're gonna make 6. That's a simple way of kind of explaining that, but it's very, very important when it comes to trading to understand that you are going to lose. It's written in the small print, but it's not really in the small print. It has to be understood that every single day you are going to lose a trade, or if you're scalping, you're going to lose every day. But if you're day trading, you mightn't necessarily lose every day. You might have 3 good days and 2 bad days. You might have 5 good days, but you're going to have losses in those 5 days. You might have a whole week where you do nothing but lose, but that is probably one of the best things that can happen to you. It's going to tell you your strategy that was working is no longer working and might need a bit of tweaking. And then when you tweak your strategy, the market conditions are going to remain in that kind of way, hopefully, after you reworking your strategy, that things might start picking up again, and you might, after adapting your strategy to the new market conditions, it might actually start working for you again. And it will, well, provided you make the right changes to your strategy. There's nothing guaranteed in this game. The only thing guaranteed is that you're going to lose money, but it's that the money that you're making back is exceeding the amount you're losing, and that's the whole game. And it's not put out in any YouTube videos that I've seen anyway, where they tell you, like, they might glance over it, but they don't actually explain the way loss works. And there's a thing in trading, there's a psychological kind of, not condition, but there's a psychological thing to do with losses. And it's when your losses feel, losing €50, say you open a trade with a €50 stop loss, losing €50, but on a similar trade making €50, you get all bet up over losing the €50, but you don't feel the same. If you lose €50, say you feel 7 out of 10 emotionally, but when you make 50, you only feel a 4 out of 10. Your losses are a lot more, 7 out of 10 on a sadness scale, right? When you lose, it hurts you more. It hits harder than a win of the same value. And that's one of the things of trading psychology, and I'm going to bring out videos on trading psychology, because if you don't have your head straight going into a trade, you're going to pull your stop loss. You're going to pull your trade without it hitting your stop loss. And most likely, if you pull your trade before you hit a stop loss, it's going to bounce back in the opposite direction. And it's not programmed in that way. It's just coincidence. When you are emotionally invested in, like, there's logical investing and there's emotional investing, and you need to just give up emotional investing. In emotional investing, you need to suppress your emotions and take positions and don't look back. When you take a position, you need to be 120 million% confident that you are going to be happy taking that loss if it occurs. This trade here, let's find a good example of a trade. I think I had it last week. There was a decent loss on USD JPY. Was it on USD JPY? I think it was. We'll throw back to the 15. Here we go. Yeah, right. So I'd probably even have an entry reason in on this. Yeah, right. Here's a typical example of losing a position off of just everything being right, but things going wrong, right? So I saw this flat out, but I saw the retracement come back up and pull back again. I waited for the bullish engulfing. It came in a variation, right? So if I just move this out of the way for the minute, we see the price came up. I could have gotten in here, right, for the position, but there's not enough of a reason for me to get in that location, nor here, because a bullish engulfing requires the low to be below here, the high to be above here. But you can have, that's a bullish engulfing, but then you have a bullish engulfing variation, which is when the low is, when you have basically this here, right? The low is below the low of the previous candle, but the high is above the high at this one. But the high didn't actually break the high, right? The high didn't, but the next candle did. And that's what you call a bullish engulfing variation. And with the bullish engulfing variation, you lose a little bit of profit, but you're still getting in off a valid entry reason. That is only the entry reason part of the strategy that I applied in this particular location, right? So I entered the position after I saw the bullish engulfing variation. I was after seeing bullish pressure. I was after seeing a trend heading to the upside, but I entered the position. Price went up halfway to my take profit level, but off of the trend line that was drawn, it hit that level and it bounced off it. Do you get me? So it bounced back and it hit my stop loss, and it never came back up in the direction. It continued in a consolidatory kind of fashion, with lots of kind of sell-offs and rallies and whatever. So that's one example of a trade that I took last week. That just didn't go for me in the way that I intended it to. But look, there's another trade, a 2-hour trade, not the best kind of a trade ever, but I targeted previous levels of support, and sure, like I targeted previous levels of resistance, or a previous high that was made, and it made it. But after that point, I was kind of seeing a little bit of a bearish kind of a trend happening, and I stopped longing because I've been longing the whole way along here. So I've been taking longs the whole way along this uptrend. So that's the kind of end of my longs on USD JPY for last week. But when we come into this coming week, we're starting to see bullish pressure coming back again, because when there's a big bull run like this, right, big bull run, we'll just highlight this in an orange rectangle. There's consolidation, right, at the top of an uptrend. We'll knock it back to an hourly chart just to make it a little bit more readable without too much noise. Noise meaning like just random price movement. Basically, knock it from a 15 to an hour. You take you reduce the amount of clutter on the chart by 4 times, so it makes it a little bit more. Then do the same thing again, reducing 4 candles to 1 again. So you can see, look, 2021 started, right? Price has been continuously making new highs, and this is typical of that arc, that upward arc that I was talking about there a while ago. But we have been seeing this bit of consolidation at the top of that uptrend, and what to take from that is when price blows up to the upside, you need to give it a chance to, calm down again. And that's what I didn't do. I was taking longs at the top of this, expecting it to go higher, obviously. Like, I wouldn't be taking long positions if I didn't expect it to go higher. But it decided to take its consolidation. It decided to take its rest. It was after running it was after running the marathon. It needed a couple of days to kind of chillax, and then it's gonna, blow. Well, I think it's gonna rise again, but we still need to confirm that. We have these levels that we have to contend with over here. If we put in raise just so it's a little bit easier to do. So look, we have highs here. Put on the thing. So like we have a kind of a. Why is this not snapping? Snap. Oh, because I have it turned on, but I'm holding control. So we kind of have a support zone. Or sorry, I keep saying support. English just isn't my thing today. So we have a resistance up here in this location. We have another resistance coming in here. A nice bit of resistance coming along there. I keep double clicking. So we're starting to get to that level, and I might, seeing how things open, I definitely wouldn't take a trade on a Sunday night. Nothing happens and I can't say that as fact. Things do happen on market open on a Sunday night, but you don't really get that real push of a Sunday night. The real push comes Tuesday morning. The real pushes, through my experience, and I think I talked about this before, is Tuesday at 8, Wednesday at 10, and Thursday at 4. And that's 8 a.m, 10 a.m, and 4 p.m. So 0800, 10, and 1600, right? Those are the times that I've found through the years that have had the most significant kind of market reaction, market movement, just through my experience, right? So, right, we'll start we at the very, very start we only had one, and we were talking about Bitcoin, and then a few more people came in. So we'll just hop back over to Bitcoin, and we'll just give it a quick little look. I think this is the Bitcoin chart. So this is the 4 hour on the Bitcoin. So if anyone has been tuned into my Instagram, you would be after seeing that Bitcoin actually created a new level this week. So if we hop over to the 15, because that's what I've been looking at a good bit lately, we can see that Bitcoin actually made a new high. So it was so that was the previous high of the chart. I just have it plotted in a red line. If you were here at the start of the thing, we were talking a little bit about how the high will have future impact. So previous levels of support will, the more recent it is, the more of a influence it'll have. We went over that before in the support and resistance levels video. But so I mark my ATH. ATH meaning all time high. So like you can see, I think TradingView will show it in here somewhere. So like it'll show you the 52-week range. It'll show you the high of the last year, the low of the last 12 months, and that's a running figure. So every day that'll change, or every week, sorry, that'll change. In the day, that'll reset every 12 hours or every 24 hours. So it's basically said in the last 24 hours. Bitcoin has moved from 59,273 from there to 61,700, basically is what it's saying, and it's where this is showing is where it is based off the day's range. So we could use that maybe to signify a bit of so the fact it's over here on the lower side might be showing that it's at the end of a retracement. If you see it right close, it could be signifying that it's more of a retracement. And just a quick tip on Bitcoin is extremely volatile, and as are every cryptocurrency that's ever been made, they are extremely volatile. There's like when you look at there's huge movements. We were looking at the ATR indicator at the start. So up here we have indicators and strategies, and you can just search up not in favorites. I think I might have a favorite. Yeah, ATR. So if we add the ATR is going to tell us how volatile the stock has been over the last 14 periods, right? So the figure is telling me here is in the last, so knock it to the hour. So this hour, Bitcoin is expected to move $632.76, right? So we can see here in this hour candle, we should see a price movement of $630. $630. That's the expected movement of this particular time, right? And we can use that to determine stop losses as part of a strategy, right? So if you're using an indicator based strategy, right, when any of my strategies will all have this purple line, which is a smoothed simple moving average, right? So we just knock it off the chart and I'll just reconfigure it. So if we put in simple moving averages, so there's loads of people that create their own indicators, so you can go in and you can use the point editor down here to actually show or to reconfigure it. So if you weren't here at the start, I showed the RSI indicator and my two versions of the RSI indicator, which are part of a particular strategy that I apply. So this one would be looser than this one. This would be a fairly strict strategy. So basically meaning that price has to go to an extreme level of so like if I just put both of them onto the same chart, which is a little bit ridiculous, but you can see on the 75-25 one, a lot less of this breakout in the overbought zone is prominent than in this one. So there's a lot more in this one than this one, but this one means a lot more than this one. But if this might be a little bit too tight, too aggressive, or too this might be too tight of a strategy for some people, because they mightn't be getting in enough, they mightn't be getting into trades enough, they mightn't be actually opening enough positions off of a strategy like this. But that's only one strategy. I apply multiple strategies to multiple different things at any given point in time. So you can actually combine the two of these. You can use the RSI to give you an entry reason. You can use the ATR to set your stop loss. And what I mean by that is you might use the ATR, so we'll knock off this one. So we'll just keep the two of them open, like that. So if we were to set a stop loss, say we were to take this, I keep dragging the wrong thing. So if we were to take a trade here, need to pull that. If we were to take the trade off of this, just as to cherry pick an example, right? Say we were to take a trade off of that, and we know the market conditions at that particular point in time are saying that there is an RSI telling us it's $363 of range at that particular point in time. So you're going to take wherever you have your stop loss plus that little extra bit, right? Just to give you the volatility. It takes the volatility of the market out of your stop loss. So I'm showing this to you on a Bitcoin chart, and I shouldn't really, because this is something that I'd use more so in Forex. So if we opened a position, we'll just cherry pick a random bullish example here. We'll delete that trade off. So we can see here that we have a bullish movement in the markets. So we get in, say after, look, that's a good enough entry there, right? But we want to put our stop there, but that's only the most recent level of support, right? Which for me definitely wouldn't be enough to say to me that I'm happy with that. That could easily just fall back down and retest that level, right? So you'd put it below it, but by how much? The ATR helps you decide that. So at this particular point in time, we have a 14 pip stop loss. So we can see in the middle, see 14.0, right? Of the red bar. That is, so the red bar that's there, that's basically showing you stop 14 pips, 12%, and the pips in as 1.4 or 14.0, so 14 pips. But we see that the ATR at this particular point in time is reading 5.6 pips. So 56 pipettes, 56 points, or 5.6 pips. So when we read a currency, we read the pips as the fourth decimal. So the fourth decimal there, I can't move it now because it'll change. But the fourth decimal, if you just throw your eyes down to the corner, you'll see 0.00056. That means that there is 5 pips, 5.6 pips. So you round it up and you do 6 pips, right? So you'd take your 14 and you'd add 6 to it. So you'd put your stop loss at 20. So 20, it doesn't have to be exact, but for the point of the example, we'll just leave it at there. Then you determine your lot size off of your stop loss, right? And I'm going to bring out a video explaining this because this is really important, but I'm going to glance over it here. You determine your lot size based off of your stop loss. So if we're taking this trade, you'd be targeting this zone here so you see consolidation in this location, a high here, and you see this, so you'd be kind of banging it in the middle of it, going for a nice, you could probably target a 3R here. So there's a 3R trade, nice bit of profit there on a very loose, relatively loose. That's a 20 pip stop loss. That's a fairly standard one. But with the euro US dollar, right, when it comes to setting a stop loss on a euro dollar pair, this is actually an interesting part of investing. If the euro is in the right hand position, if the euro is quoted, right, a pip is worth a standard lot. No, how do you explain it? So if you're trading a micro lot or equivalent, you're trading 0.1. You're I'm really confused myself here now. Right. So if you're trading with micro lots, 1,000 units of currency or 0.01 lots, right? Your pip value per pip is 10 cent, 0.1 euros, right? If it's in the right hand position. Hopefully this isn't confusing everyone. But the value per pip is if the currency pair that you're trading has the euro in the right hand position, in the quoted position after the slash, right? It doesn't show the slash there, it shows the slash up here. So if the euro is in this position, it's 10 cent for a micro lot, a euro for a mini lot, and 10 euro for a standard lot. So for a 100,000 euro, it's 10 euro, and for a mini lot, it's a euro, and for a micro, it's 10 cent, right? But if it's not quoted, and if it's in this format of euro USD, my trading account is in euro. So I take my, what is it? The exact, the way it is put, I was working stuff out there earlier. So you take, where is it? Is it this one? So okay, based off your lot size, the pip value, right? The standard pip value of the US dollar, right? Which would be, the US dollar is in the quoted position. So you take the value of what's in the quoted position, which is the dollar, and you divide that by the exchange rate at that particular point in time. So if we want to know what a euro, what my pip value per pip is on this pair, it's going to be say I'm trading a mini lot, right? Take it just for an example. I will be taking 1 and dividing that by 1.19. So 1 divided by 1.1949. So that's going to be 1 divided by 1.1949. That's going to be 83 cent per pip of a movement. So for every pip on the chart, it's going to be 83 cent, 83.68 cent. So that's going to round to 84 cent, right, per pip. But on a dollar
if my account was in dollars, that would be $1, but mine's 83 cents because my account's in euro, right? So that's might be after confusing every single person in this call, and it confused me for the longest time, but that's how you calculate your value per pip to determine your stop loss. A stop loss, or sorry, not a stop loss. I'm really all over the place today. To determine your lot size, you take 2% of your account. If you've a €500 account, you take 2%, which is a tenner. You divide that by the value per pip multiplied by your stop loss, right? So if we are trading Euro USD on a €500 account and we have this position that we're opening, right? We're going to take, I just have my calculator here. We're going to take the 500, right, which is the account, multiply that by 0.02, which is 2%, which will give us 10, right? So we're going to take 10, well, we'll start off by going 0.83 multiplied by 20 pips, and we're going to do 10 multiplied by, or 10 divided by 16, what was the exact figure, 0.84 multiplied by 20, so 16.8. So we're going to do 10 divided by 16.8, and that's going to tell me that I'm going to open a position of 0.6 so it's going to be 0.6 lots, right? Not 0.06, which would be 6,000 units of currency. This would be telling me to open a position of 60,000 units of currency based off of stop loss, my account size, and was that right? I worked it out off of the mini lot example that I gave, because that was in my head of the mini lot example, because we did the value per pip calculation off of the mini lots, right? So in that example it was 8.3 cent per pip, if you get me. So we're going to do that same example. We're going to take the 10 and we're going to so 0.08, right, and we're going to multiply that by the 20, which is 1.6, right, and we're going to divide 10 divided by 1.6, which is going to tell us 16. That can't be right. But okay, look, I'm really all over the place today with this. I'm just completely fried for some reason, and it's not really showing a true reflection. But for the mini lots example, it was true to word. We have the value, and we'll be opening a position of 6 mini lots. 6 mini lots, 0.6 standard lots, because it's 60,000 units currency, because it's 10,000 by 6, which is a mini lot, by 6, which is 60,000, or 0.6. If it was a standard, it would be 1. 2 standards, two standards, it's 2, and so on. So what kind of time? It's gone 8 o'clock. So how long has this stream been running for? Get a figure on probably OBS. Yeah, we're gone over the hour, an hour and 12 minutes. So yeah, look, I suppose that's all really. If anyone has any questions, just quickly drop them into the chat. I'll gladly answer them. If you thought that this live stream was any good, sure, drop a like on it anyway. Definitely, it should show that you're enjoying them. Anyway, because it's, you know, like I'm sitting here for an hour of a Sunday evening where I could be sitting up watching Netflix or whatever, so I genuinely enjoy doing this. It's just, if people have any questions, just drop them into the chat there, and then in the playback, in the actual video that's created based off of this, there'll be the chat will pop up then for anyone that wanted to, that, you know, any questions that were asked in the video, they're actually going to pop up there as well. Anything that I was sent privately this week that would be fairly relevant for this week, you know, for the video itself, not really jumping out at me, just kind of things of you know, I know one person there, they were opening an AvaTrade account and they were having a little bit of trouble. My advice with AvaTrade would be, I'd say go with AvaTrade if you're thinking of opening an account, because I find I've never had issues withdrawing funds. If any, I don't know if I've said this before, but with my trading account, I trade it all the time. I put every month, I put a sum of money in, so I boost the account by giving it a small injection of funds, and that's every month. And then every 3 months or every quarter, like a business would, or a stock or a company, they pay a dividend, and I pay myself a dividend. I'm the 100% shareholder in my trading account, so I'm going to take my cut, and I have all my figures written down. I know exactly my profit based off of the quarter. So this when March is over, I'll be taking my first quarter dividend. I kind of like to treat it that way because that's the way businesses treat their that's how they do. They send out they pay their dividends to their shareholders. So if you hold a stock and you're holding it, and it comes to the dividend date, you get paid based off of, because you're technically a shareholder in that company. So I pay myself that way. So from my trading account, when it comes to the end of March this year, I'm going to pay myself a dividend, and I pay myself based off of the figures. So I have all my figures worked out. So when I withdraw my funds from my trading account, I'm withdrawing 5% of the profit that I made in the first quarter of 2021. That's my profit rate on when I take my profit, when I take my wages from my trading account. I take 5% of my first quarter earnings, and then when it comes to the second quarter, I'm going to take a 5% of that for myself, and that keeps me inspired to trade. That keeps me on my toes. That makes me cop on and say, oh look, you got that now on your last quarter. If you do this, if you do the same thing again, only this time it's going to compound on what you made the last time, so you're going to actually make more. And when you take your 5%, you're going to have more than what you had the last time. And then in the third quarter, you're going to have more than you had the last time. And that's the way I think people should treat a trading account. I treat my trading account like a business. I'm constantly growing this trading account. This is this is an account that I'm going to hold, and when I eventually trade this account to, say, my target is 100,000 euro of a trading account. So eventually, when I get to that level, I'll be able to just withdraw funds to leave myself with 100,000 in the account, and then just trade that and take all the profit. Because it's like, the reason I only take a 5% dividend is because I want to grow the account, but I want to keep myself inspired. So I pay myself the 5% dividend so I keep myself inspired. And it's like, I'm sitting at home all day, every day, doing college work. I don't have expensive living costs at this point in time, so I can afford to take a lower dividend. If I had to pay rent, if I had when I had the NCT in February, I had to withdraw a sum from the trading account. I'm after putting it back in now, but I had to take a sum for a repair on the car, and so on. So that's the way I treat it. I treat it like a bank account, because the thing about trading, and you need to this is what kind of made me cop onto trading, is if you put your money into a bank account, and I think I've actually said this before, with a bank account, there's a fixed shitty interest rate. But with a trading account, you decide the interest rate. You can decide whether you want to trade your account on a 0.5% interest every month, or you can decide that you're going to trade that at a 5% interest every month, or 8%, or 10%. Depending on how good you are, you're going to decide that. And depending on if you're willing to put in the time and the money into your trading account, and pushing yourself to educate yourself to a level where you can consistently make profits, you're going to have bad months. But you want your good months to outweigh your bad months. And it's all about the good versus the bad. You need to really understand that there is losses involved in this game, and to not leave those take hold of you. So look, thanks very much to everyone that was in for this call. This was it's my pleasure, absolutely, sitting here for this time. I'm thrilled to be able to bring this, because I've spent so much time, thousands of hours, putting together all this information in my head that I kind of feel that I really want to share it, because it's really, really hard to get to get all the information from the right places, from the right people, and just collaborate it all together. And then I'll be just another person that's relaying that information back to the world. And that's what I want to do. And if you want personal coaching on trading, and that's not just general to these kind of videos and streams and stuff, I do have the thing over on Patreon. I'm still trying to get things fully sorted with the Patreon thing. Things aren't running as smoothly as I thought, but that things on that front should be running okay soon enough. But if you are thinking about one-on-one type coaching, if you want to DM me on Instagram, I'd be able to get back to you, and maybe we could organise something maybe over PayPal before the actual Patreon thing gets up and going. So if you want, the one-on-ones, or if you wanted to get in on a private Zoom call, the one-on-one sessions would definitely, for anyone that's struggling, if you're consistently losing, or if you're having trouble actually getting a grasp on technical analysis, or how to read a news report, a trading based news report, and all that kind of stuff, it would be definitely, if I was in the position of someone with very little experience, I would love to have something like what I'm offering, if you get me. The whole point of this thing is to provide to people what I wish I had: affordable and actual quality mentorship that is very, very few. A lot of it is very distant and bet around the bush, is my experience with things online. And my whole thing is to bring something that's clear, concise, and just real information that's not something I wish I had at the start. And that's my whole kind of thing with this. I really want to provide something that I wish I had, to make sure people in the position I was in at the start would actually get a less of a rocky start. Like, I started off with very poor risk management. I'm lucky I didn't blow the account, because I wouldn't be in the position I am today, with a nice size trading account with a good lot of information, consistently being profitable. If I blew the first trading account, I could have packed in the whole lot. And I wish that, well, I'm grateful that I didn't, because it could have completely knocked me off the track, and I definitely wouldn't have ventured far into the world of investing at all. But through the years, I've educated myself. I've done courses. I've watched endless YouTube videos of reputable online mentors. I've gotten a mentor. I've lost a lot of money. I've gained a lot of money. I was always skeptical in the beginning that it wasn't real. There wasn't money to be made in the investing markets, but firsthand, I know for a fact when you know what you're at, you're able to actually generate a decent off of a fairly minor investment. You could treat yourself to your dinner on a very, very small account every night. But you're not growing your account at that. You're going to be just splurging every bit of profit off on your dinner every evening. You could go to a restaurant and order yourself a nice steak and chips and enjoy that. That could be why you're trading, to have your steak and chips. Or you could trade like I am, to plan to have a proper size trading account that I will be able to invest in whatever I feel that when the time comes, I feel there's a position that might be worth getting in on. Like, here's a little bit of insider information that people might want to know. Airlines at this point in time mightn't be a bad one to get in on. They're still relatively low. They have kind of risen a little bit in the last couple of days, weeks. But definitely coming out of COVID now. Like, it makes a lot of sense. Airlines have been completely dead, the last couple of months because of COVID. A lot of airlines have been really, really low. Things with holidays, we're coming into the summer, vaccine passports, all that kind of stuff is all going to be taken form. Like, just before we finish, I'll open up a quick Where is it? Stock. So we'll just take Ryanair, right? Ryanair. If we look at Ryanair, so when it comes to Ryanair, like we can see COVID, see what COVID did to the likes of airlines, right? Like that's what COVID did to airlines. Look, completely made ribbons of, just completely. Look, boom. The whole, like, look, there's the March, April. Look, completely fell off. Earnings missing. Look, miss. Oh, that one made earnings. Consistently missing their targets because of COVID. They're not able to operate at full. They can only have half mast. So that's to do with ships, but it's the point of the analogy. So I'm not saying to get into airlines. Ryanair is an expensive share, like share price of 110. If we go for another, so you could pair Ryanair with another company, right? Companies in the same industry can follow a similar price pattern. This is all stuff for another day, and this is actually dragging on. Yeah, it's 20 past now, so we'll wrap things up. I see there's only one person left, and so look, I hope you've enjoyed everything that I've brought to you there this evening. I think personally what I'm saying is valid. Whether you think so too is your own opinion on things. So look, lads, thanks very much for joining me. I don't know why I was looking there. The camera's right here. Thanks very much for coming. If you've thought that you've had anything, if you think that you've learned anything valid in this, definitely like the video. Share it around. The more people we get in, the merrier, because the world of investing is there for. It's all about volume. The more people that's involved, the better. And it's definitely something that I think young people should be taught from a young age. And I think as part of school, more so than anything, there should be, the world of money should be taught more in schools, and it shouldn't be more of a choice like it is in a lot of Irish schools, where you can do economics and business and accounting of choice. I think it's more of a thing where you should actually be not forced, but you should definitely be given it should be more emphasized, because the world of investing is it's there to be explored, and it's there to be exploited, because it's a zero-sum game. If you're making money, someone else is losing it, and vice versa. If you lose money, someone else is after making it. Zero sum, and it's there to be exploited. It's absolutely, that's the one way to look at it. You have to. It's there to be used. And it's, if you get a good base and you understand how the game works, that's when you can make your money in it. So look, lads, without dragging things on too much longer, thanks very much for watching this. It's been a pleasure, been my pleasure. If you think you've enjoyed, leave a like, drop a comment below if you think with timestamp maybe of something that might be important in the video or whatever. But yeah, thanks very much for watching, and I'll be uploading a video someday this week, and sure, you can go and watch that. Just make sure you have your notifications on. If you're not subscribed, definitely subscribe down below as well, because these live streams every Sunday, some people say, oh, I forgot about the live stream, whatever. Turn on your notifications, it'll pop up on your phone and you won't forget. So look, thanks very much for joining me, and I'll see you all soon. Alright.